Over the last week, I put together a series of presentations on diagonal spreads. They're much like a covered call, except that instead of a long stock position that you're selling a short call against, there is a long call position. So you're buying a longer term call out there in the future as a way to hedge against the unlimited risk of the short call that you're selling in the short term. And it's constructed very much the same way. So in the example that we used, we bought an at the money call that was out in long-term expiration, and we were selling a one move out of the money call. Now, a diagonal spread like this, a diagonal call spread like that, is really constructed when you're bullish but you want a hedge. So you're trying to reduce your risk, but at the same time take advantage of a little bit of an opportunity to the upside. Well, can you apply the same strategy but even become a little bit more neutral on this whole thing? Is there a way for you to increase the value of that hedge if you're even less confident about the future of the market or whatever it is that you're trading? And yes, there definitely is. It's called a calendar spread. And it's just one version of these two option spreads that can really turn into a nice way to create an internal hedge while creating an opportunity for income, while still maintaining an opportunity for growth. And it's something that you can really experiment with quite a bit. Now, in order to walk through this, try to keep our the ability to compare a calendar spread versus a diagonal spread, let's stay with the same instrument. So in this case, we were looking at the XSP index options. I liked those because they have European expiration. That means you don't have the early exercise problem. They're plenty liquid, and they're the S&P 500, so they're kind of internally diversified as a stock index. The XSP is 1/10 the size of the SPX, so it's nice for traders who don't have very, very large accounts. So they're not trading $13,000 contracts, they're trading $500 contracts or even less, depending on what strike price and expiration. Now, in this case, right now, XSP is priced at about $88, and I'm going to sell or buy a calendar spread. So we're going to be buying and selling in this case. So I'm going out 1 month and I'm selling a call. Now I'm going to go, I'll just go one move out of the money. I could just as easily go at the money or even a little bit in the money, but in this case I'm pretty close to the $90 strike price. That's a nice round number at $90, and I'm going to make about $5.50 or so per share, or about $550 per contract. Now, not too bad. At the same time, I'm going to buy a longer term call, so something out about a year in advance. So in this case, I'm looking at December 09. It's almost exactly a year. And I'm also going to use the $90 strike price. This is the difference between a calendar spread versus a diagonal spread. So this is how you construct. They have the same strike price. And in this case, I'm going to be spending about $13.50. That's how much it's going to cost me. Now you'll notice immediately, here's the difference. The relationship or the ratio between what you made as a premium that you accepted this month versus what you spent in that long option is almost 40%. So that's much higher than what you would see, for example, if you were selling one move out of the money. So if we were selling the 95s instead of the 90s, the ratio between what we paid and what we received in premium is very different. And in exchange for taking a little bit more risk, we have more upside opportunity if the market actually moves to the upside. So in this case, if we imagine that we were to sell the 95, we would be making about $3 even. So our relationship in this case goes down considerably. It changes from nearly 40%, so in the high 30s, to around 25% or so. And the difference in the premium is it allows us a little bit of room to maneuver. So if the market were to move up, we're not going to be called out until we hit $95. So we would accumulate more profits to the upside. So it's really a matter of just knowing what's my attitude. Am I more neutral towards the market? Because if I'm more neutral, maybe I want the bigger hedge, hence the calendar spread. If I'm a little bit more bullish, if I see or sense a change in the market, maybe then I'm a little bit more bullish and I'd want to sell that out of the money call so I don't get called out as early. Just one way to modify that same basic two option spread, that diagonal spread idea, turn it into a calendar spread and adjust it for the market environment and the way that I feel about the market. So I hope this helps to answer a lot of the questions I was getting about precisely this, as to how can they use the ideas of a diagonal spread but increase the amount of the hedge to compensate for the uncertainty in the market.